Okay. Good evening and welcome members of Pax Group. Special guest Yra Harris, new member of the CME Group Director, and Judd's Group's members. We're going to follow up on the price action from Thursday, Friday, and discuss the implications of the G7 meeting this weekend, which we can already see the S&Ps are down 37 points. Ira, Pax, welcome you guys.
Hey, thanks, Judd. Thank you, and everybody. Thanks for coming here on a sunny afternoon. You know, it's always a time for my family and for my friends. It's always a time for us to get together. But we thought that we like doing these conversations on Sundays. You know, because it gives us a chance while we're preparing for the markets. It gives us a chance to bounce some ideas off of one another and to really get some insight as to what's happening. Now that's a lot of what we used to do on the trading floor. And it was a great benefit to me. I don't have a background in economics. I have a background from my degrees in philosophy and theology, so that didn't help me much with trading. But what did help me was learning from Judd. My life changed in in August of '98 when I met Judd, and Judd started to teach me how to trade and mentor me, and would change through conversations with men like Ira. You know, Ira Harris, who was, you know, a director of the exchange then, and a well-known and well-respected trader and macro analyst all over the world. So throughout my life, I've done nothing but maybe earn a master's or possibly a PhD degree from listening, asking questions, and then what I didn't understand and don't understand, looking up and doing my own research and doing my own homework. So anyway, I thought that it would be great to have a conversation like this, again, to prepare for the weekend. Or to prepare for the week ahead, especially with all of the incredibly important macro issues, economic and geopolitical and otherwise, that we're facing, not just across the country, but all across the world, which is affecting everything that we're doing. And how do you, when Ira starts talking about his last blog post today, you know, which I just, by the way, I am here. Okay. I want, you know, and then while all of us here and some of us, some of the people here are newer traders. Some have been trading quite a long time. Some are very wealthy. Some are on their last $500.
Okay.
And, you know, the questions are always going to wind up being, and I love answering them because, as you know, I'd sit and I'd listen to you guys talk for hours and ask questions as a young trader and as a young man, and things that I had no idea. I didn't study. I just didn't know. You guys did, you know, the generation that came before me. And I learned how to put those thoughts and ideas into actionable trades. So there's a lot to unpack here. And with that, I'm going to just shut up and do what I used to do and let Ira and Judd and everybody else talk and ask questions. Oh, another thing, if you guys have, because everybody's muted, so if you have questions that you want to ask Ira, just go ahead and type them in the message box, okay?
All right, sounds good. Well, the first thing is that we just came to a big macro level in the S&Ps.
Everybody in my group, remember what that level is?
We're coming right down here into the 200-day. So
yep.
Now the question is, can this thing bounce?
Well, all right, so let me just say that real quick. And I asked, anybody remember what that level was? Remember what the first level was that I had announced that I would be covering some shorts when it reached there? No matter what time it was, you know, I don't initiate trades overnight, but I manage positions overnight. All right, nobody's typing it in there. 28.11, thank you, John. So I had orders in at 28.12, and I covered another 25% of my shorts. So thanks for reminding me, Judd.
So you caught that for almost 30 handles before the opening, before 8 o'clock on Friday, and then you caught the whole break plus this.
All because of our conversation all because of the price action, but I don't know that I would have held I don't know. We have not been holding positions because these markets have been headline driven and not trend driven. But from our conversation with Ira on Thursday, I was looking for a short. Or no, I'm sorry, on Wednesday. I was looking to be short. Thursday and Friday, I was looking for it. And I caught it.
Ira, you were trying to leave us. We got it. Pax wound you up and got it all out of you in the last 5 minutes. We all went short.
That is absolutely right. I was had to leave, but Pax, hold on one second. Yes, I Yeah, that's, I was trying to exit because there was a whole lot of stuff that, and we just kept pouring out, and you can see what's going on. Although we don't have enough yet because the G7 concludes through tomorrow, but it's as tense, more tense than I even thought it was going to be, to tell you the truth. And Macron is way out over his skis. I've been reading the media, the news, and the responses, and all depends, of course, where you sit is how you see this. Unfortunately, nobody has, or very few people are objective enough in their analysis. If you're anti-Trump and you're pro Macron, you see this all in a good light. But Macron did some very interesting things by inviting the Iranian leader to the G7. There are things going on here that are really, really pushing his buttons, and they're trying to push his buttons. And I'm not sure that I would poke this bear. I think Jerome Powell made a major mistake, and I don't think that he makes a mistake because I just don't really believe that he understands what's going on here. That you can't poke this bear. He's gonna snap back at you, and he's got everybody trapped right now. As much as he's trapped by the elections, and everybody's making a big deal about that, everybody needs to play different cards and respond to him whether they like it or not, and they are responding to him. So we're going to see more and more. I still believe that before he departs from Europe, that he's going to be discussing tariffs on the Europeans. And that was the initial call. Everything that else broke. Well, I expected him to push back against Powell, especially as I put out in the blog. I think that blog covered a lot of ground as much as I could in deference to this. But there's even more, because now we got Mark Carney talking about the end of the dollar. Mark Carney, I don't have a lot of regard for. I liked him when he was the governor of the Bank of Canada, but when he went to the Bank of England, I think he's been he's too political, and he's been wrong. He's been wrong about Brexit. He's been wrong about the way the economy would react to Brexit. I guess in due time, everybody will be right, but he's been wrong it's been over 3 years now since the Brexit vote, and everything that he projected has not proven out. So I know all the people with counterfactuals will come at me, but I'm just telling you that he hasn't, and now he's just looking for a bigger position on the world stage. I think Mark Carney is angry that he wasn't chosen to be the new director of the IMF. I think he wanted the position really badly, so now he'll be out there banging the drums. But let's go from there, because I think we're actually seeing the markets pretty much as we thought we'd see them.
Ira, I saw that Carney. I didn't know whether to ask you about Carney or whether that was just a crackpot kind of a thing. But I mean, is that being taken seriously?
He throws it out there. Don't forget, it's Jackson Hole. And it's supposed to be an academic symposium. So he throws it out there for thought. And yeah, it's serious. But I'm going to tell you what, it's really nothing that we haven't discussed in this room that I haven't discussed in the blog really for quite a while. Now, are we getting to that point? Yeah, maybe we are. Yeah. Listen, the dollar certainly has issues, and rightfully so. It has, but that's why gold's going up. So, gold is, again, I can't bang this drum loud enough, hard enough, or long enough to tell you that the gold is going up because of the inability of central banks. And what's the headline in the FT today? Let me read, which will be for tomorrow's FT. What is it? Where central bankers rethink everything at Jackson Hole.
Oh, great.
Okay. Now, I actually wrote a response into this because I read there's 160, I don't know. But the second paragraph in this article is the developed world has experienced a regime shift in economic conditions. James Bullard, president of the St. Louis Federal Reserve, told the Financial Times. Something is going on, and that's causing, I think, a total rethink of central banking and all our cherished notions about what we think we're doing. Now, that just blew me away, and I actually write a response into it. I'll read the response because I can't say it better than I did. Because step back and think about that comment. Really, step back and think about it. So here's what I write. Bullard forgets a major thing. Central banks have built massive balance sheet positions, and now they're fearful that they've been wrong in the dependency on the models they hold so dear. And yet the useful idiots keep buying sovereign debt, pushing yields ever lower. The bursting of the global bond bubble is going to cause tremendous pain, especially for the pension funds who have been so complacent, believing in the wisdom of the central banks. Hey, Ben Bernanke, it ain't rocket science, but as long as the financial media treats central bankers as all-knowing, we are heading into massive storms. And then I get a little wonky in the way I end off. I mentioned 3 people who see this stuff for so many years, but that statement from Bullard, who never ceases to amaze me, is unbelievable. And yet people are going to keep buying sovereign debt. You got to be out of your friggin' mind. The central bankers are telling you that they're also thinking about that maybe they're wrong. Wow.
So talk about the hedge. Talk about gold being the hedge against the central bank losing control of monetary policy and not a hedge against inflation.
Yeah, listen. Ultimately, yes, it is a hedge, but in the world that we live in, which is why we've talked about gold currencies, and people say, "Oh, you're a gold bug." Not a gold bug, but my flippant retort is, "Well, you're a fiat currency bug," because if you're going to accuse me of one thing, and I'm not a gold bug, how I wish I never owned an ounce of gold, to tell you the truth. The world would be a beautiful place, but and lions would be laying down with lambs. But as long as we have policymakers who insist that they know everything and are willing to roll the dice on massive positions in experimenting, you know what? Gold becomes a legitimate hedge, as Jim Grant so wonderfully says, against the PhD standard. And that's what in a fiat currency world, when central banks begin to lose credibility, we are in a very dangerous time, which is why, listen, you can be a trader and buy bonds all over the world. But if you do it as an investor, it's now what I call the foie gras trade, because they keep stuffing these bonds down the throats of certain types of investors, and it's not going to end well. It can't end well. I'm sorry. And if the answer is Jay Powell's remark, very flip remark to me, is the ECB, you don't have to worry about it because they have a printing press. That's not a reason to own sovereign debt. I'm sorry. That's just where I reside in. So do with it as you may. But and everybody in this room who's been here for a while and has talked with me, and I can't say it more enough on CNBC, when you have to take everybody to task, because it's not an inflation. Look at bonds are going up and gold's going up. So tell me where the inflation move is. It's not. It's about the credibility. Now you could say, Ira, well, bonds are going up, and if the credibility, who'd be buying bonds? Bonds are going up because you have central banks who have distorted the mechanism so dramatically that it makes it too difficult for what we used to call, and I still love the phrase, bond vigilantes. and as long as the central banks are willing to control them. And how do we know that they control them? It's fairly easy, because what was the first bank that did this? The Bank of Japan. And there were people, great traders. I'm talking about Bruce Caxton of Kovner, Bruce Kovner of Caxton Partners. I'm talking about Stanley Druckenmiller. I'm talking about Paul Tudor Jones. Some of the great global macro traders, George Soros, who termed, after they got so beat up trying to short JGBs, the Japanese 10 years, because, well, everybody could see what the outcome was going to be, but you couldn't fight the Bank of Japan. And with the Bank of Japan, of course, were the massive Japanese pension funds who were buying bonds, but they were buying bonds for a far different reason, because Japan was actually in a deflationary cycle, deflation. So prices were going down. So if you were a Japanese investor, it was perfectly a quality investment to buy bonds, because if inflation was a negative 1%, and I'm talking about in real terms, not talking because it may be more. So if you got 20 or 30 or 40 basis points on a 10-year, you were still getting a real yield of 150 basis points, so to speak. That's a pretty good return. And don't forget that when everybody was trying to crush the Japanese, when they said, well, they're going to have inflation, you got to sell these bonds. Their debt is increasing dramatically, their public debt, and these are the perfect sense. Except that 97% of all JGBs prior to the real ramp up by the BOJ were owned by Japanese investors. So if you were a Japanese investor, a Japanese saver, it made perfect sense to own those bonds. I can't say the same thing about European debt, because there is no deflationary spiral in Europe, and there certainly is not an inflationary spiral in the United States. So if you're buying a 10-year note that yields 1.6%, 1.55%, inflation is, let's be kind and say it's 1.5%. So the real yield is zero. And again, I say we're being kind. That's nothing like Japan. And people who compare it with Japan, I think, really lose the contextual argument, because it's nothing like that. It's far different. But that's the world in which we reside in. Again, I don't fight markets. Okay, I'm not the only people I know who were total contrarians who always did well were Board of Trade grain traders. Those were the greatest contrarians I knew. I'm not of that ilk. So, and I'm not belittling that. Listen, there's fortunes have been built on that, but that's not my nature and that's not my style. I want to know in a bigger picture what's going on. So that's what's going on. But you have to be an imbecile, and I'm not. Sorry. If you fit, yes, you're making money because the bond prices are going up. But if you buy them and hold them for any duration, I'm going to say you're an imbecile. But that's just one man's opinion. And I'm not getting short them because, again, I can't fight the central banks. And you're right. You're right to be buying them on a trade basis because that's what the central banks are doing. And you better damn well hope that they keep doing it.
All right, so Ira just threw up the SPU bonds quarterly.
Yeah.
Back to 2000, so everybody can see it. And I'm pointing to July 2017. And the next quarter, that first week, you and Anthony and were a Top Step trader. That's when we had a 20-year breakout in this spread.
Right, from December of 1999.
Yeah, and so that gave you the 265 points or 365 or whatever it was, straight up to the 2965 target. Now, what I'm going to pull over here is the gold and euros chart on a semi-annual, and you can see that we're breaking out above a 10-year level. So if I'm looking for the same type of provided we stay above 136.31. Now you know where you're wrong. Right here, it just sold high. That's where you manage risk. I'm looking for.
It's a lot of feedback.
Okay, well, Ira, is that your team or somebody else's?
That's not me. I don't know who that is.
Somebody's got to mute.
That
All
sounds like a live feed from the G7.
That was wonderfully funny. That was great. A bunch of children yelling in the background.
Oh, geez. That's right. That's exactly what the G7 is.
Oh my God, it was great.
With Baby Huey as the headliner.
Yeah, he's got a lot of help there, though.
All right. So my point here is that this can really start to go. And I've been talking about this for a couple days, featured it in Friday night's DMI. You've got a breakout in the silver as well. So you got to pay attention to this stuff. This, because I'm showing you that when these moves start and you get a macro breakout like this, and that's why we're not looking at a 5-second chart. We don't get caught in indicator traps. We're not looking at a short-term 5-minute chart. We're looking at charts that can tell us what the markets can really do. And this is.
Let me ask Judd. Let me ask you a quick question about that. So, and I know it's obviously it's going to be a repeat for what many of us already do know, but. What is a SPU bond spread or a NASDAQ spread, a SPU bond or NASDAQ bond or even Russell bond? And, where did you and how did you and Ira decide to, use it, or how do you, that kind of thing? Just the history.
That's Ira's gig.
Real quick.
Okay. All right. Let me explain to you where it came from. I was out for a run on my lunch break in like 1992. I was running along the lake, and it was that's what I used to do for my lunch. I used to run. So I was running along the lake, and I literally, I can tell you exactly where I was. I'd been thinking about certain things, and the markets, and I got to North Avenue Beach, and there was a phone there, a pay phone. For those of you who don't know what that is, it used to be. So I picked up the payphone and I called Howard, and I said, I'm on this run, and I'm thinking the way we treat the S&Ps, it's like they can exist in the ether world, untethered and have no. I said, I don't believe that. They have to be tied to something. I said, and the greatest thing that moves them is interest rates. So I said, what? Let's look at the S&P versus the 30-year bond, just to get a sense of where the market is relative to one of the most important instruments, debt instruments in the world, and let's see if we find anything. Well, Howard dug deep, and he couldn't believe the pattern and the relationships that we saw developed, and that's when we started looking at it. And he back tested it, and he looked at it.
You know what else I told Paul?
Everybody needs to mute out.
I said, right now, the day, history is repeating itself. And I said, in years to come, I said, that community is going to gather and talk about how much they had. And they didn't do a fucking thing.
All right. Ira, now you're going to have to unmute
Wait a
again.
second. I'm going to unmute Ira. I don't know why these people can't.
That was funny.
It's going to be another honey you suck in bed.
Hey, there he is.
There he is. Hang on a second. I got to find Ira. I muted him.
Find Ira, and then also Peter.
Hold on.
I found myself. Here I am.
Unless of course Peter.
Hold on. Ira, I'm looking for you. You're at the bottom of the list now. I got to find you. There you are. Okay. Sorry. Go ahead.
That's all right. Can you hear me now?
Yeah.
All right. So that was really the advent of that, is that, I had said it. And when in looking at it, we found that there was a real relationship. I can't tell you more than that. It's actually pretty simplistic. But when you see the moves that it's caught, highs and lows, it is phenomenal. And I don't know why. I don't know why. It was just one of those things I was thinking about. And, upon analysis, we found that there was a relationship. So we used the futures you can use whatever you want. It's worked for me. As Judd points out, going back to October, that was another time that it really carried its weight because we got a substantial move out of that straight up. It was so fast. And then I said, it's just time to sell it because it was just parabolic. It went parabolic for months. So that's all there is to it.
Let me ask you, so just real quick, one last question. So obviously I knew that story, but I what I've never asked is, and I knew that Howard had done some work, but how far back did Howard go in order to determine that, yes, this had validity?
I can't tell you that. I don't know that. It's his proprietary work. We just discussed
Got
it.
Got it.
Nothing more.
And Howard was a CQG user, so I'm assuming he probably at least went back to 1982.
Yeah, I don't know. But you know what? Again, I think he was amazed at what it showed. I really do. I think he was said, well, and said, well, you're onto something. But Howard and I had a lot of those eureka moments because I would do some thinking about things, and he always respected my view when it came to that stuff. So and then he would, and then then when he would do the work, if he would verify it, he would, you go, wow, it's, sometimes, or he would test it and go, no, there's nothing here. You're wasting my time and your time. And I certainly respected that. So that's really it in a nutshell. Nothing more than that.
Yeah, and it's great because it works on, Ira looks at it on like a 240-minute time frame on out. I look at it on the daily stuff, and you have to know how to manipulate the spread bars to see the data properly. Because if you don't manipulate the spread bars properly and how much data is coming in, you won't see the right chart. That much I know, and I spent a lot of time with the head guy at CQG going over the inputs to make sure I'm looking at the right chart. So I wouldn't trust it on a Bloomberg terminal. I wouldn't, because they're going to be line charts. This is the only place I trust the data inputs because I can manipulate them. So
and that's it. I can't tell you, so you can find fault with it. Great. It's so a lot of times I feel that when you simplify things, it works out far better. Then you can dig deeper if you want. And we've done some cross correlations with using the Bund DAX. So there's been all types of back and forths on it. So that's that's really, and it's nothing proprietary. I'm just telling you what I how simple it was, and yet what really proved its worth was, of course, the high that was made at 1631.32 in December of 1999. And think about how critical that caught that. I don't know why it caught it, but it really proved itself many times. And then we would see numbers off there, whether they were Fibonacci stuff and numbers, or, especially highs and lows. And Judd will attest to it because, he would remind me, he says, have you looked at it? I got to go back. I haven't taken a look at it. And we did, so.
We always use them it's a confirmation tool. It's a big confirmation tool.
Right. That's right. And when it confirms, it's really powerful.
Sometimes you don't get the breakdown. You think, it's not confirming on the spread, so you don't want to take it, and like a short, and you've seen that through the entire rally. And then when it started giving you the confirmations that it was breaking down on the weeklies, then you didn't want to be long anymore.
Yeah, that's right.
Yeah,
that's right. And you know what? When you're looking for an exit strategy, it's not a bad one to utilize that way. And now we know on the bigger picture, which we're going to get a test of that 200-month moving average, which, as Judd just pointed out, was that 1631 area which has been such a valid technical area on this whole thing. So, and we're going to get a test of it. I have no doubt about it. Unless, because again, if we look at Friday's action prior to Trump and his effort.
The retaliation?
Yeah, well, his attack on Powell. Prior to that, the market, as we know, actually wanted to rally even after China, because we know what the market was up early. China comes out with the tariffs announcement from their aspect, and then right after Powell speaks, the market actually goes higher again. So it took, and then Trump crushed it when he started going after Powell in a very aggressive way. So that's what the market took away, and that was it.
Yeah, and the spreads, if you look back at the spreads topped in October on the monthly, and all we got on the weekly was a week retest, and then the week, the first week in August, outside of Ursa lower week, you had a big break. It tried to come back up and do some work back up towards this gap, and it couldn't even get close in futures terms. It couldn't get above the mid 40s in the S&Ps. And that's, what, I look at is to see if it can actually do something. We needed at least above 50 and better above 65 to think that this could hold and sustain. And it never even got back to the 50-day. So now we're at the 200-day. And, Matt just took some money here as you should.
Well, and look, Judd, everybody knows, everybody in my room, and you do too, because you're still my mentor after all these years later, that when after Fed Day, when we came back down and tested these levels, we were on a group mentoring call, and I was trying to teach everybody how to manage positions, and I was talking about the targets and where I was going to cover. Meanwhile, I'm watching them as we're talking about them. I'm literally watching the market trade down to 28.11, 28.10, that whole 10 to 12 area where I was planning on covering some. And then I was watching it come back down to the 200-day and below to our target, to our macro level. And of course, watching it come. And I didn't put my order in. While I'm teaching and talking about how to execute, I just simply did not execute. So I am not going to make that same mistake twice. We came down to the macro level, and I covered, not all, took some profit down there on 25% of my position. And once we get down to not the 200-day, but the next macro level, which is a little bit further than that, I'll be covering there a little bit more. Well, I'll cover more than half my position there for now. But that truly goes back to our discussion, and at the end of it, I poured all over the news. Well, not all over, but for me, I poured all over the news this weekend. There's 2 points I wanted to bring up in regards to there is absolutely a discussion that is ongoing out there about President Trump starting the next thing would be to continue to raise rates on China up to maybe 50%, but also discussing, and this is what we talked about the other day, threatening fresh tariffs on Europe.
Oh yeah, I believe it. I've been adamant about that, and I believe that they're absolutely going to take place because the Europeans have done nothing. Especially Macron. Macron is grandstanding here, Again, you want to challenge, fine. Let's have that discussion. But he's grandstanding, and it's not playing well with the Donald. You're talking about somebody who feels slights every which way.
And yeah.
And they're playing, and Donald keeps raising issues. He raises the issue of Russia back into the G8. Okay, you know what? That's near and dear to him. But these guys are playing with him, and the fact that now the French said that they told Trump ahead of time that the Iranian president was coming. Don't know whether or not they did, but tomorrow is a press conference from the G7. This should get interesting because, again, Trump is in a fiery mood. The White House keeps sending out these things. This morning, it looked like there was some walk back, from China. Somebody asked the question, did Trump, feel, and it was reported by the media that, maybe he was suffering a little remorse about. And then the White House comes out and says, no, what he meant was that he wished he would have made him tougher and strong and higher. So, it's really hard. You have to be on your toes. So when you say you're reading, you have to read everything. You have to, because you have to discern what appears to be pure nonsense. Now, I hope, and many others hope, that Trump would walk back some of this and that they would actually come to some type of real agreement. Maybe Xi will show up next, and maybe maybe we can do it, but that ain't going to happen because, as somebody in this room, I think it was Pete who talked about the guns of August. Was that right? Was it Pete? Who was it on Friday?
Yeah, Peter did.
That was Brian brought that up, but it kind of
Brian, I'm sorry.
the point quite well, yeah.
Yeah, right. That once these things are in motion, you got to be very, and again, Kudlow's out, but what is he, where is he at with his comments today about China? Well, he doesn't think this will escalate. You've been wrong every step of the way. Everything you say proves to be wrong because Trump undoes whatever you think is going on. And then you have, wow, I don't know whether it's in disarray by design, because that could very well be possible. It could very well be possible that it's all by design to be, to appear this way. Now, somebody would say, well, you're giving them too much credit. You know what? This is an apolitical issue. I don't, when I do this analysis, as you in this room know as well as anybody, and anybody who's read my blog for the 10 years I've been writing, my politics, if you know my politics, I've made a huge mistake because my politics should not enter into it. We analyze things in what we try to be the most objective way possible. Now, that doesn't mean that I can't call Trump a buffoon for doing things, but that doesn't mean that's what I think, that I think everything he does. No, I think some of the things he's been right on, he just doesn't communicate them very well. He's certainly right on dealing with China, not in the way that he does it, but in the big picture. He's been right on some other things too. But I vehemently disagreed with his tax relief, although I was in favor of corporate tax relief and a middle-class tax cut. But that tax plan got some corporate tax relief, but nothing for the middle class. So I thought that was very faulty. But when he's right, you have to say that he's right. And when he's wrong, I'll call him out for it because I'm not married to anybody. Just the same I felt about Obama. The same I felt about, when did I say? Oh, Bush was already gone. So I've only had, I've had Obama and Trump. But these are things that are very, very important. And the politics, to me, no, we're here to seek out potential profits. That's all. That's all. As I say, the rest is gibberish. You want to go, turn this into CNN or MSNBC or Fox, please don't waste the time. You're not here to prove your point. We're here to discuss things as they relate to the ability to make potential profits in what I and others deem to be the global macro world. Your time scale is your time scale, not mine. The things that I try to put forward are always difficult to time, and if you have bad timing, you're going to lose money. But things to think about. And listen, nothing says it better than Thursday's discussion, because it led to people to be aware of what could possibly take place, and the potential was there to make significant profits. And you know what? Again, if you sat and listened to the talking heads on television, you never would have gotten this, because it's not what sells. And don't forget, they're selling bull markets. They're selling bull markets, and they're selling belief in every facet of the narrative. They provide the backdrop for that narrative. Me, I don't accept anybody's narrative, and I owe Ben Hunt from Epsilon a lot of credit. He really changed even after all my years, but him and I've had some discussions, and his work on narratives has been exemplary. I don't accept anybody's narrative, and that's exactly what. Who was that, Matt? Was that you, Matt, talking about you were digging through everything today? Or is that when you're digging through everything, that's what you're trying to discern and trying to get yourself away from, is accepting the narrative. I don't accept the narrative. I have to dig and find it and go, well, if that makes sense, fine. But I'm not buying anybody's narrative. And you could see the faces on CNBC. They were so caught off guard by Friday. Their faces were chalk white. And Santelli wasn't there. He told me he wasn't going to be there Friday. He had a long planned day off. But they were all caught off guard. But that's because they accepted with a predisposition the narrative coming from Jackson Hole. Well, I think Powell made a gigantic mistake by even giving that speech. And I said that before he gave the speech, because nothing good was going to come of it. And Trump was wrong when he said, well, Fed policy coming out of Jackson Hole. There was no policy coming out of Jackson Hole. It was never intended to be a policy. Unfortunately, Bernanke had opened up that window, and Draghi and others followed it, and he did set policy from there. But Powell made a mistake. He never should have given that speech. Nothing good was going to come out of it, and he should have just proceeded. But again, who did they drag out? We heard from Esther George. We heard from Rosengren. They were busy dragging these people out. Like, I was surprised. I was supposed to be surprised that Esther George was hawkish. Well, she voted against the rate cut on July 31st. There was no surprise there. And I give her a lot of credit, because she stays the course. Rosengren, the same way. So there were no surprises. And it left Powell in a dangerous position, because he had to walk back their hawkishness. And he tried to, but he wasn't going to go that far. And then he wound up, as I talked about in the blog today, and we talked about on Friday, and we talked about on Thursday before it happened, that Trump was not going to deal with this in a very good way. And it's exactly what happened.
So, Ira, there's, the guns of August moment kind of feeling that we had it on the end of the day on Friday, that I can see like two different things happening. That there's a collision with China, with the U.S., and then there's a collision in the Euro, and the sides, the Macron is a weak, way weaker than he acts, and the bureaucrats who run the EU, they can't concede to Britain's any sovereignty or anybody else, and Britain's demanding its sovereignty, and they're not going to back off. So that's a collision that looks like certain to happen, with a lot of geopolitical, financial consequences. And then over in with China, you can argue that they might be making a mistake, thinking they can make Trump back off. The U.S. political system is weak, and Trump, I don't think, maybe appreciates that the Communist Party of China cannot show weakness at this point. They can't concede to Trump. If Xi did so, his own people would probably kill him. and but also that they believe that they're on course to become the greatest nation on earth, and they're not, and they're not going to be turned back from that. So
Well,
I'm saying,
you know what?
I don't know how much they can concede. So
Well, I would, you know, I don't go there because we're making presuppositions that I'm not sure. And why go that deep? The Chinese are trying to be the Chinese, and trying to raise their stature in the world. But listen, you know, if you read Chinese history, and I've read quite a bit of Chinese history, you know, their anti-colonialist stance weighs significantly on a lot of their decision making. And that's what the West fails. It's like the West would like to wipe away its colonialist past. Well, you know what? It's in the words of Chalmers Johnson, and I hate to throw out these names, but I give credit. I only throw them out to give credit. You know, they talk about blowback, and there is blowback from past policies. There's a lot of blowback. Yeah,
but the Chinese also have a feeling of a racial and national. I mean, their whole history of thousands of years. All this stuff is embedded in their own internal, you know, how they view themselves.
Well, yes, you know, there's no question. Listen, every empire in China was an empire. Every empire in some capacity felt itself to be the manifestation of a divine blessing. You know, I don't care whether it's Spain, and I don't care whether it's certainly France. I'm sorry. All you do is have to go to Versailles. Whether Britain, you know, in the United States with its manifest destiny, you know, so I'm not going to hold the China. You know, that's just part of.
But I bring it up
because of history.
Because I'm speculating, obviously, but I'm making an argument that they really can't concede. And on Wall Street Week, you know, Kyle Bass has made a really strong, detailed argument, the same argument in his talk. But I guess the thing I wanted to just point out was there's several markets that have multi-year levels being taken out at, you know, this weekend, and we'll see where they really trade this week. But you know, gold comes to mind.
Yeah, you know.
And what was the other one? The yuan. The yuan, another move down.
Yeah.
And that might be engineered by the Chinese themselves. I don't know.
You know, we don't know. We don't know whether it's just, you know, money reacting, you know, and nervous, and but I really don't think the Chinese at this point want to play that card, because they're looking for allies around the globe too. You know, Trump talks very tough, but he would like to have some support here, which is why we may get a little more conciliatory. You know, and I wasn't sure about this morning's tweets from him and what the news reported, because there might be a little conciliatory, because everybody, it's hard to go it alone. You know, Trump likes to put that face on that they'll go it alone, but they're not going alone, because at the same time, they were blasting out that they were close to making a deal with the Japanese. So there's a lot of things moving here. You know,
So our friend Judd here on his work, which he sells on his matrix, he's got some pretty big upside targets on gold from where we are right now. And if we break out these levels right now, I just want to throw that out.
Yeah. And you're looking at silver copper I just threw up.
Oh yeah, my favorite.
I mean, and that thing, if this thing's good, it's coming back here to retest 88.14. It's going to come back and retest the August 2016 breakdown.
Yeah, you know, that's your world. I can always see it in the way, and I respect. You know, as everybody knows, I respect technicals. I don't pretend to be a technician of any standing, but I know that when you're involved in trying to create the greatest amount of potential gain with the least amount of loss, you better have some sense of the technicals, because otherwise you're just adrift at sea.
And here's the gold copper. I mean, it's already breaking out of that level above that 2016 area. So now it's, you know, spend some time up here over this level to see if it's real. But, you know, my opinion is it's real, so I'm treating it as such. And, you know, you just got to stay the course with the gold. Everybody's got huge leads on it. There's no reason to get out of it.
No, you know what? It's really, and it is, they'll use words like haven. It's really, and when you see a headline like the central banks, you know, and the FT coming out of Jackson Hole, wow, that headline to me, that shook me more than anything else I've read today, because this is what they're coming up with and this is what they're saying after they've made these phenomenally huge bets. Really? The ECB has a $4 trillion balance sheet. The Fed has a $3.5 to $4 trillion balance sheet. Bank of Japan, an enormous balance sheet. Bank of England, an enormous balance sheet. The Swiss have been playing a game of alchemy for quite a while now, and there are major bets. Tell me what shape you really think the world is in here. And I'm not, you know, that's just reality. This is not supposition. And to hear Bullard make that comment, it really should make everybody sit up and think, going, wow, these are major bets made. And now they're saying that they're not sure. I think that statement does more to undermine and to bring Congress into examining the Fed and what it's done. And he actually makes Trump, he elevates Trump. It's unconscionable to me. What are you thinking about? But if this is the feeling coming out of Jackson Hole, then I keep coming back to the same point. And again, you guys are all going to say, ad nauseum, tell me what the exit strategy is. Tell me how you exit this. Tell me. Yeah, I just...
there isn't one, and I don't see it. And I'm just going to pull out one number for everybody right now. And you ought to write it down. It's 27.2875. That's another 100 points lower. So that's a long way off. But in today's world, you never know. But that's when everybody in the world jumps ships on U.S. equities.
All right. Do you remember the last time we traded that price? Do you remember what happened to me? Actually, no, it was well, maybe we traded it in June. I don't know. The first week of March, Judd, we had broken from 2011 down to the low was 27.23, if I recall correctly, and it was the first week of March. I built up a nice position that week.
Mute yourself, will you please?
I built up a pretty nice short position every day that week, and on that Friday we opened up at 28 or 27 quarter. The top of the opening range was 27.28. So I got long out of there, but not enough to cover my shorts. Not enough to cover my shorts. When we got above, I forget what the price was, but when we got right around the time we got above 27.28, something had happened with the peso and with the railroad. I forget the railroad that the proxy for Mexico, Southern, yeah, that Ira likes, and they had both turned up, and also that, you know, hey, this is a risk on, get out of your shorts, cover, and I didn't hesitate. I got out of my shorts, and the market that was it. The market didn't look bad. We rallied 150 points from there, 200 points.
Hey, one other thing, and I'm not going to stay much longer, but there was another article, and I don't know, Matt, whether you picked it up this morning. Excuse me. Bundesbank Wiedmann opposes new stimulus.
Oh yeah. Boy. Here we go.
Okay. Now you know my view that it was a mistake not to make him the head of the ECB, because you need a German as the head of the ECB. And of course, Macron.
I think that statement just told us why, Ira.
Absolutely.
That there's so much dissension that, again, Don't believe the narrative, because the narrative that they want to push at you is, oh, Germany's going to very meekly head into a fiscal stimulus package, and everybody's in favor, and the ECB is huge rate. There's another rate cut at the September meeting with more QE or QQE is because they might just be buying stocks now, financial stocks. So, and it sounds like Wiedemann had gone away, and in fact, last week they were running with us. The Bundesbank is behind fiscal stimulus, and I said in my blog when I saw that statement, I said, yeah, that's well and good, but let me hear what Wiedemann has to say. Yeah. Well, now we know what Wiedemann has to say. He said he was particularly cautious about government bond purchases because they could blur the line. So he hasn't gone away. Don't believe the narrative that the mainstream media is selling, because again, they're selling what a lot of policymakers, because that's who they interview and that's who they talk to. They're not calling me. And they're not calling people who may see things differently. No, they go to their sources, who they have access to. And everybody there is pushing out a line. Sorry, it's just, that's why I work so hard to try to look beyond the standard narrative. But here he was this morning saying, well, hold on, not so quick here. And that, of course, I raised a question in today's blog, and it's a serious question that has to be looked at. And we've talked about it in this room. It's where my thinking about this came from this room, which is the German backstop of the ECB balance sheet a form of fiscal stimulus? Because if you think that it is, then it raises all types of questions about what people think the outcome of this is going to be. And again, everything that I'm looking at, not everything, but a lot of things that I'm looking at have to do with measuring the significance of the planned exit strategy, and do they have one? And that's it. And that's where I'm going to leave you. But I think that everything that we discussed on Thursday, forget Friday, is where we sit right now. The only thing missing is Trump going after Europe. And if he's disillusioned enough with this G7 that he starts talking about tariffs on European exports to the U.S.
Ira, do you think Draghi has had a conversation in the past with Angela Merkel about his strategy of a Eurobond?
I don't know. I have to imagine with somebody it's taken place.
Because like I said on Friday, somebody better send the Germans a memo that's his plan.
Well, I think that there are people in Germany who see it. If you read Wiedemann, I think that they see it and they fear it because the German populace. There's an article today also. Let me see if I can find it, and then I'm going. I got to go. Let me see. I might be able to find it. Let's see. Let's see where I saw it. Maybe I didn't see it there. Let's see. Where, let's see.
But Ira, something that we've never actually delved into, and maybe we can leave it here and make it a conversation for another day.
Yeah.
So we have the idea of a Eurobond, okay?
Yeah.
But we've never discussed what the result of that would be. Would it be a good thing? Would it be a bad thing? What the potential trades might be if that were to happen?
I've thought long and hard about that. And if it's done with, Germany really being involved in this and signing on to it, it will be an initial boom to Europe. That's my thought process on that.
You think you get a stronger euro out of that?
Yes. Yeah. Yeah. It would give, because then you would have a real alternative backed by, let's see if I can find this article.
And like you've said in the past, what price would Germany extract for the privilege of being the backstop?
Yeah, it's that's the penultimate question that we have to.
And I've thrown this out there, and I know you said, well, that would violate the EU treaty, but Germany just comes back and says, to hell with the treaty. You want to use our checkbook, then we've got, in Germany, as Germans, we've got to go out there and cut whatever trade deals we need to be able to cut in order to keep this checkbook full.
Yeah, no, because nobody's going to do something for nothing. Of course, the mainstream narrative will be, well, they're benefiting from a very weak currency, so that's the trade-off for them. So they have to be willing to deal with it, So they're willing to be the backstop.
And that takes it to something you've always said. For our enemies, we enforce the rules. For our friends, we bend them.
Yeah, that's for
something like that.
For our friends, for our friends, we interpret the rules.
Right.
For our enemies, we enforce them.
Oh, that's Cook County to.
I'm not saying anything.
No, you can't.
But that's
that basically comes from the way Greece was treated. That's where I think Ira's,
Well, it's the history of the world. As we always want. We want justice for the other guy and mercy for us, right? It's the way the world works. We're all guilty of it. You should understand my situation, but enforce the rules on him. He's a bastard. So go ahead. We don't like.
So Ira, like we said on Friday, in the short run, there isn't going to be a trade deal until we walk the path of some sort of pain, and both sides have to come to the table. But the depth of point A to point B, I think, is where the markets have grossly overestimated the possibility of a trade deal, because that's the narrative. Everybody, every analyst, strategist. So, do you think we'll get a trade deal? Do you think that's all the your friends in the media ask is, when are we getting a trade deal?
I'm looking for this article. Let's see. Hold on. Let me see if I can.
And nobody asks what would it look like.
No.
All right. So, Matt, I just want to bring your attention to this 100 by 3, because this is a big level, and and guys have a lot of money in trades tonight. Don't give them all back.
Yeah, that's right. Okay, but here I'm going to give you this, and then I'm definitely going. There's a Bloomberg article. It was posted by my favorite guys who are the best global macro traders that I know. So, sorry, Matt, you're good, but these guys are really good, and they know how to deal with me. These are the guys that now they're Praxis Trading, because I was honored to give them the name that I had used. But here's the title of the article on Bloomberg: Germany in uproar. Now this is from yesterday. Germany in uproar as negative rates threaten saving obsession. You want me to say it again?
Give me a second, please. Yeah.
That's the title of the article on Bloomberg.
Yeah, good.
Germany in uproar as negative rates threaten saving obsession.
Yeah, great.
So you can go find it and read it. I really just scoured it. I have not read it. I've just been overwhelmed by so much, but it's worth looking at. And that's where I'm going to leave you at. And we'll pick up. But listen, again, what's the purpose of this whole exercise that we go to? Is to be prepared for what's coming at you, not what did, because the charts will show you that. But we want to be prepared for what's potentially coming down the road. And I think we've done that very well the last few days. So I congratulate all of you. And it's been good. You pushed me to my limits, and I appreciate it.
Well, here, let me, and Ira, thank you. But one last thought for me, too, that goes in regards to what Angelo just said and follows up with your saying is that what's the end game? How do we get out of this? What are the mom and pops that have their 401ks that think they're good? There is no end game. It's going to be ugly. It'll be dangerous.
Well, but it may be that equities way outperform.
Sure.
Because to me, the sovereign debt markets are the most vulnerable because people just blindly, and yet right now they're right. They're harvesting big profits if you're a trader. But if you're doing it as an investment, you know, Leon Russell said it best. Watch out now. Beware. Take care. Because it ain't going to be pretty.
That's right. Thanks, Ira. And trade the market that's in front of you, one macro level at a time.
Thank you. Again, thanks so much, Ira.
And look and listen for comments coming out that may reverse this. Because don't forget, nobody wants to see the world in this state. So, you know, maybe some sense will be brought to the table.
Well, especially fearless leaders, so you can have anything happen overnight.
Oh, yeah. And there's also, let me give you one more. There's an Ambrose Evan Pritchard piece from yesterday. Germany mulls ban on negative rates for savers as irritation mounts over ECB's extreme policies. So there's pushback, and we have to be aware of the pushback, because if you get pushback, the world becomes a different place. And again, the central banks, the fingers point to the central banks.
Always.
Yep.
And there goes the price of gold, as we just mentioned that.
It's okay. All right, guys. Good luck.
Thanks,
okay.
Ira.
All right.
Thanks.
All right. So just a couple of comments just on the technical stuff, guys. When you get to a big macro level, like in the S&Ps that Matt just took some profits in, you're going to get, at the same time, you're going to see that you're going to get extended in the gold, the silver, everything else. So these trades aren't independent. They're all kind of the same. So what you have to do now, depending upon how you've articulated the trade, whether it was options, you're wearing them. If you're futures, you can manage them. But manage them you should. And Pax, you can finish up and you guys can have at it.
Well, I mean, you know, that just goes exactly to what we were talking about, as you had mentioned here. And by the way, I'm dropping in that article that Judd had talked about. I mean, not Judd, but Ira had talked about Germany in uproar as negative rates threaten saving obsession. Understanding these points, you know, what do you guys? I wonder how many people, you know, dropped off while Ira was talking about the macro. You know, what does a macro? And I asked this question myself a million times as I'm making a fortune on the trading floor. You know, but I suppose it wasn't until it was during that time. It was after Greenspan cut interest rates by 50 basis points. A story I told on Credeli's TV podcast. When Greenspan cut interest rates by 50 basis points. So I'd lost over $1 million that day. $1 million that 4 years prior to that I didn't have. I had it because I listened to Judd. I learned how to trade the way that Judd told me the day that I met him, I'll teach you a process of trading that will work any time in the world, at any market in the world, anytime, any place, on the floor, off the floor. I was like, yeah, okay, I'm in. You know, so anyway, that's how I was able to take that loss and keep on ticking. The point is that I didn't even think up until that point that I needed to learn about what the macro issues, and then therefore the capital flow from in and out of different asset classes to you know, the stock rotation inside, or the rotation of inside one asset class, what that meant to me as a trader. Well, after I saw something that almost or could have destroyed my career happened to me very quickly, I decided that I better get a plan and I better figure out what was going on. And instead of sitting there listening to these guys talk and pretend I'm listening and yawn and, you know, look at my clock, wondering when I was looking to go run 5 miles on the lake. I'm looking to go grab a smoke and have a little sambuca in the afternoon. And yeah, I started to listen. I started to pay attention. And that's when I started to really that's when I became a real trader. You know, I still did what I did before, but now I started to have to be able to understand and ask those questions. So I'm lucky. In our room, all day long, you know, in my room, we've got everybody that's learning how to trade a system, a process that I learned how to trade primarily under Judd, and then I had kind of made it my own after MF failed, and I was forced to start doing things quieter and slower, and you know, and I devised the rest of the system on my own to the day where Judd and I are working together, you know, separately but together, and I get to ask questions of guys like Angelo, who you guys listened to speak 5 minutes ago, and hopefully is still here, and Peter, you know, guys who understand the macro level and understand the macro stuff way better than any of us do, because it's partly their job to, where it's our job to act on it. And how do we do that? Well, we have to take action. If we don't take action, we don't make money. If we are not involved in the market, we do not make money. And do you make money at trading S&Ps by selling 24 halves and buying 24 evens? Yeah, you make a half a point, but is that a way to make a living? You know, you want to trade like the big boys. You want to sell 24s and 28 24s and buy back 27 24s. Not quite as simple as just throwing a 10 lot on and putting a stop in and wait until it gets there. Anyway.
And you have to listen, because, I mean, it was just something that Ira said. We were looking for the timing, and we thought it was going to be Monday, and it was just something he said at the end of the conversation. It was just like, okay, you know, it's time to put some short exposure on and get longer the metals. It was as simple as that. But, you know, we're kind of trained to hear that now. You know, after 45 years for me, and Pax has been doing this an awful long time, and he's paid attention. And these conversations keep you trading from a side, keep you in the flow of the market, and have you looking for opportunity from the right side of the market. And then our technicals get us in at the right level.
You know, instead of spending time on the weekends listening to the Cub game or watching the Cub game, which I do, you know, I do spend some time, though, reading Ambrose Pritchard. I do spend some time looking over Danielle DiMartino Booth, Peter Brookvart. You know, every time that Ira, as you guys who follow me on Twitter know, every time Ira posts a new blog post, I put that up there. You know, Angelo, Peter, who do you guys look to? Who do you follow? You know, those are the things that are important. You know, it's to understand these issues, but then how do we funnel that back into our personal trading? Trading. How do we funnel all of those macro big issues back into our screens? And those are the things that we've talked about 1,000 times, a million times, that we need to continue to hash out.
And Matt, let me say one other thing too, which is related, and that is during periods of prosperity, and we've had 2.5 years up until September 30th of growth accelerating, and then prior to that, you know, going back to 2008 as well, some ups and downs, but generally up. The thing is, the central banks have been doing all of this stuff throughout this time period, but the shit or the warts, let me call them the warts, always bubble to the surface when growth starts to decelerate. Okay? When during periods of prosperity, the markets ignore it because profits paper over everything. Now that works in reverse. So all the bad shit, you know, starts to bubble to the surface. So now what do we've got? We've got Trump. We've got central banks. We've got growth decelerating. We've got, you know, issues with China. All right, and I'm going to say it again, that consensus is way underestimating the risk with a China trade war. Way underestimating the risk.
You've been saying that a long time.
I'm going to say it again. I do not believe we're going to get one anytime between now and the 2020 elections.
So
and
how
in
do
fact,
you think that
you notice, you know, Trump's pivot on Friday and over the weekend. All right, he's going to continue to twist corporate America's arm to get the hell out of China. So what I'm going to keep an eye out for are signs of, you know, the first major U.S. corporations that decide they're going to throw in the towel. because they went in completely naive, thinking that they were going to have unfettered access to 1.2 billion consumers. And that's not what they got. And they gave up their intellectual property, their partnerships, all sorts of stuff. And that, you know, again, they should have known better. They were dealing with communists, okay? And, you know, they need to get out of there and make their stuff somewhere else. So I'm going to watch for signs of that, of major companies saying, okay, you know what, we need to get the hell out of here. It's not worth it. But the underpricing of risk due to a trade deal not happening, I think that's pretty huge. I mean, I think that's worth the Christmas lows.
That'd be it.
Yeah, I really agree.
Okay, I think that could be worth, you know, in combination. See, growth is, the thing is, growth is decelerating, okay? But if all of this geopolitical stuff ends up making it worse at the margin, right, then this sort of soft landing that I thought we would end up with could literally just end up into a, you know, a recession, or maybe a little bit harder recession than anybody thought was possible.
Okay.
There's your Christmas. There's your Christmas lows easily.
But easily, but beyond.
Right.
And maybe beyond.
Yeah, November. I think that will break Christmas, and I want to hear what Judd says. But break those Christmas lows and bring us back down to November. Was it November 16? You know, election time.
Yes.
2100.
Right, so here's two things. One, you got to take it one level at a time, because this is not going to die an easy death.
No, it's not.
And the quarterly right there shows you exactly where all the macro stops are. Right there. That's everybody's busted gut low. Right there. 27, 28, 75. It's another 100 points lower.
Got that price imprinted in my mind.
Now, whether we can get there, we can't get there, you know, that's going to be a huge target for September, because the shit will truly hit the fan if we get down there. And guys will just give up, totally give up on their retirement plans, everything else plans. They'll just want out. So what we do is go from one level to the next. We're trying to figure out how we get from A to B. And the less, you know, it's nice to have these conceptual talks, but you still have to get from A to B. And
that's exactly correct. Yeah.
Right. And that's all risk management, guys.
The price action will always tell us. The price action is always going to tell us where the market's going to go and how the market's going to go. That's one of the first things I said to Ira when we started talking is, hey, thanks for the conversations Thursday and Friday. I was already looking at, Friday morning we were looking to sell rallies to be short out of the opening range, but everybody in our room made money on the upside first. We broke out of the opening range. We rallied 20 handles on the upside, and we took profit on the way up. And we scratched them, got short in the opening range on the downside. So we let price action dictate that trade. However, because of our conversations with Ira, and we knew what we were already looking for, and the key phrases and key words that we heard made it very easy for some of us, for me and others of us in both rooms, to add to our positions as we broke through certain levels. So that's just on a daily scale, Judd. Wait until we start hitting and breaking through these macro levels, which is why I had an order resting at 28.12 to cover a little bit of my S&Ps. Next, it's only a matter of from the intraday targets like a ladder, up,
well,
down.
we have the price sheet in front of us.
And
so
then
people that don't subscribe to the price sheet, you're short-sighted and myopic.
No, which brings me to another point of making sure, you mentioned it earlier, Ira mentioned it, we briefly touched on it, but making sure that everybody's looking at the right information, looking at the right charts. That is so misunderstood, and I don't think that there are very many people that actually teach what are the right charts that people ought to be looking at? Is it a 5-minute daily or a 5-minute, 5-minute daily, 5-minute daily continuation, active continuation?
For me, I won't look at anything. I'll look at a 240-minute once in a while, sometimes an hourly, but generally I'm out, way out.
But you know what, Matt? Quite frankly, all of the above.
Right.
So, hey, Matt, I wanted to know, using these different time frame charts and, the scenario where we have the, downside follow through hitting a target in this future session. I mean, what can you recommend over the next, between now and the first few hours of trading on Monday morning?
I'm not. I won't initiate any more trades. I'm looking for 28.11 to either hold or not, but I'm not going to initiate under any trades on an overnight basis. I just don't initiate trades until regular trading hours. So I'm going to wait until the market opens tomorrow morning at 8:30 Chicago time, and that just like when we were on the trading floor, every single day the market has a few things in common every single day, and it hasn't changed just because we're trading on the computer. But every morning we have an opening range, then we have a closing range, we have a close. The closing range is the last 30 seconds. First 30 seconds is the opening range. That's always been the way it was, and it always will be. And algos have been designed. Many of them have been designed to make their breakout or try their breakout from the opening range. So, Peter, I'm going to wait. I'm already short from 29.08 from Friday's opening range. 29.04 actually was the bottom. So no, 29.08 was the bottom. 28.04 was our pay line. So tomorrow morning, I'm going to look at the first 30 seconds, and whichever way we break out is which way I'll be looking to trade. That's there. Otherwise, that goes back to what Judd taught me in the beginning of my career is don't sell weakness and don't buy strength. Most people know that. Don't buy weakness, don't buy strength.
They don't understand the concept.
Tell that to the hedge funds, Matt.
Yeah, you're absolutely right. Most people know that, but most people don't do it because most people don't understand the concept. Exactly right. And it goes back to looking at the right charts. And Angelo, unfortunately, your answer is absolutely right. All of the above, but most people don't understand that. I didn't. I sat in there my very first class with the great technical analyst and teacher, Dan Gramza. When I first took a TA class with him, I sat there with my mouth open. He may have been speaking in Greek. Oh my God, what? Holy shit! What have I got myself into? What's this guy saying? But then he said something that struck me, and I'll never forget it. Every trade that we put on has the potential to make our wildest financial dreams come true, and every trade that we put on has the potential to ruin us financially. Then I stood up, my ears perked up, and I thought, well, I better listen. I better figure out what this stuff he's talking about is.
Yeah, and here's a good example of strength. Okay, we knew that 1538 to 40 was the breakout in the gold. So the low tick is 45.40, and it goes straight out of the opening range, straight up, $12. Well, or almost $20. So if you want to take that trade out of the opening range on a Sunday night, have at it. But you're wrong down here.
Well, that's a good point.
But again, once the S&Ps hit their number, this stopped rallying. So now you got to wait till the morning to see what it's going to do. And that's why at this point, you shouldn't be clicking the mouse. All you should be doing if you have positions is protecting your positions.
But let me make a quick point is, and everybody in our room, everybody in my room knows, everybody, the opening print in gold tonight is 1545.4. What's the low of the opening? It's 1545.4. So the low and the opening print are the same. What's that mean? That's a very bullish signal until they take out that level. So, I mean, it's just something when you brought up gold, it brings it made me think of that. Peter, I'm sorry, you're going to say something and I just talked.
No, I just wanted to say that That was a really good insight, Judd. That it's the gold stopped at when the S&P hit that target number, and I'll stand by till the morning, see what happens.
Yeah,
That's right.
I'm trading this like this is a huge breakout. What's going on here with gold, and so I'm looking and I'm going in very long tonight. I went in very long, but I am looking over the next days and weeks for that to extend further. So I'll be looking for take some profits and re-enter, and I'm going to try to make some very serious money on this move.
Yeah, and you got to be careful because you know that these guys are scared shitless looking at the price of of everything they've said today, and they're going to say stuff overnight, and you can get reversals. So you have to be really cautious about what you're doing. The board is about playing the match game, and one instrument isn't going to move by itself. They all move in harmony. And when you learn to see that, you'll learn to trade better.
They're different sides of the same coin.
Yeah, there's just different sides. You can play them in a million different ways. But if you don't want to be short the S&Ps, you could have been long the bonds or the gold. You can trade it different ways. They're all this. You're right, Angela. It's different sides of the same coin, and it's how you want to trade it and what your personal comfort level is.
Yeah.
There's a million ways.
Go ahead. I was going to say, sometimes we tend to get caught up in the, oh shit, I missed this, I missed that. You know what? You don't have to catch every single trade. As long as you've got something on that properly expresses your view, right? And gold certainly is in a bull market. And once I understood China, and once I realized there isn't going to be a trade deal on any breaks, I don't care how small they are, I've been nibbling and building a position.
All right, but so that's a great point, Angelo, and that
that's where the macro view comes into play.
Yes, and that's why it's so important. Now there are a million ways to make money trading futures, intraday, daily, whatever, all those other things. But there's a lot of ways of trading the story, and we talk about that a lot. The capital flow. The other day we're all long Nasdaq, S&P. We watched the bonds explode. We watched the gold explode, and we all got out of our S&Ps and got short pretty quickly in Nasdaq. But Ange, you're so well said. We always have to. So you're nibbling. We have to start. If we have an idea, if we have an idea of where the market's going, we know at least we have an idea of what the price action and the capital flow is starting to tell us. Then we have to have something on. Now, for independent, smaller locals and independent, locals are what we called us, independent traders on the trading floor, not retail traders, but locals. So independent traders, like most of us, don't carry positions, and if you do, the guys in my room are learning how to carry positions with little to no risk after at least to the beginning capital of the trade. Obviously, we're protecting our trades. So there's always risk. But
your strategy, Matt, your opening range strategy is an excellent strategy for people that don't understand global macro, okay, but then start to learn global macro, okay, and that's when they can really get dangerous.
That's exactly right, Angelo. That's the point that I was trying to make, is how do we get to the point where Angelo is, where we have the macro story on. We have to start trading 1 lots and 2 lots and learning this process so that by the time you've been trading a few months and you've gotten confident, not just in this process, but more importantly in yourself, and you learn positive habits, now you trade intraday with an eye on longer term positions. These shorts that I'm on, I'm not going to cover these shorts, the last part of them, until I scratch them. So I've got no risk on these shorts anymore, because I'm either going to scratch what I have left or I'm going to buy them much, much lower. So as traders like Peter and Angelo, longer term macro guys are starting to nibble, we're letting the price action tell us when to get short and then managing those trades. And there's, like Judd said, millions of ways of doing that. We found ours. It works for us. Marlene asked a question earlier, just real quick, Marlene. I used the first, as we did on the trading floor and as they have for hundreds of years. Ira and Judd and I went back with Ira and talked about it, and they could only identify traders going back into the 50s that did it because of our age. But the opening range is defined as the first 30 seconds of the regular trading hours trade, or just, if there is no regular trading hours like Globex reopen, just use the opening print.
Yep. Now, getting back to studying and learning the global macro, I'm going to go out on
let's finish her thought. The problem you're having is that you're not looking at a long enough time frame chart. And you're in a 5 minute, 2 second, a half a second. I don't know what chart you're in. But if you start looking at a daily, weekly, monthly, yearly, quarterly charts, you'll see where the stops are, the real stops. And you'll use those stop levels to make trading decisions. So here, if we came down and we ran these stops and started coming back up, one, you wouldn't want to be short, and two, you'd want to be long. So you have to learn to use the charts to your advantage instead of getting twitted out by some twit head. You have to broaden your time horizon out when you're looking at the stuff so you can see something. And right now, just by your comments, you're not set up to see anything.
And another point too that's I don't see talked about very often in the Twitter sphere is money stops versus market stops. In our room, we don't use money stops. I'm going to risk 2% of my account on this trade. Now, we don't put on trades unless we have three requirements filled. One is we have good trade definition or perfect trade definition. I'm not going to get into too much of that, but we have to know where the market is telling us that we're wrong first. And I don't know that you're doing that. So where's the market telling me if I'm wrong, if I'm long, or if I'm short at a particular point, where is the market telling me that I'm wrong? Not my money, not my P&L, not my statement, but where's the market telling me that I'm wrong? If I can't answer that by the price action, then I can't put the trade on. I have no business putting the trade on unless I know where the market's telling me I'm wrong. So for the sake of argument, if I get short at 28.27, where does that make me? Where am I long? So if I sell them at 28.27, it's a money stop would be I'm wrong at 31. But I don't want to stop out unless I get to a place that I would reverse. So that's how I define my trades. That keeps me from making trades at 26.5 because I have a thought. I have an idea. No, I wait until I have actual trade definition. I know where the market's telling me that I'm wrong because,
well, Pax has got a hard number down here. He took money. And you know what? This is the thinnest part of the whole next 12-hour cycle. Nobody's trading now. It's all algorithms reacting, and he used the opportunity to lighten his risk and take money off the table. We could be anywhere in the morning. We could be higher in the morning. We could be lower than we are now in the morning. Who knows? But the point is he keeps trading to make money and to try to leave some runners on for a bigger move.
That concept applies to whether or not you're a short-term trader or whether you're an RIA with a longer-term time frame like myself. I always know where my exit is. It's usually at one of Judd's matrix levels, usually, okay, or it might be some other number if appropriate.
Oh, all right.
Okay, okay, so it all goes to, what's your risk profile? What kind of an investor or trader are you? But always, always, always know where you're wrong.
Yeah,
so if you're longer term, you maybe where you're wrong is a little bit more in the way of wiggle room, but it better be at some important number.
All right, so here's my follow-up question, Ange. So if we're using, because I'm doing the same thing with Judd's matrix. All right, so if you're putting on, all right, let's just use and we don't have to use prices, but let's just say the Russell short you had, which worked quite well, but I might add. But all right, let's just say that. So you're putting them on at the matrix level. Is your stop at a place that you would at least consider getting long? Because you're so patient that you're not going to do anything in the middle of anywhere until the market gets to our matrix, to Judd's matrix levels that we both have and are using. So you sell them there, and we know that above that we're wrong. Would that be a place that you would think about getting long? And that the only reason I'm asking is because that's how I define my stops.
No, because I have a negative view of the market. So okay. I give it a little bit more wiggle room. I may go short at a matrix level. Okay, and it may go 3, 4, 5, 6, 7 points beyond that, and it happens to me all the time. But that doesn't shake me out because I have a pretty firm grasp of what the primary trend is.
Hmm. Using
now, if we get to another matrix level and I haven't stopped myself out yet, I might wait for that next matrix level. I might. It depends on what's going on at the time.
It depends. That's always the answer. Is it?
And it depends upon how far away the number is.
Like somebody when we were still talking with Ira, I don't remember who it was, but somebody when we talked about getting down, I'm scrolling to find who it was. When I said we could get back down to the Christmas lows if X, Y, and Z happened, and someone put in the chat, they said, oh, that would probably be a buying opportunity. And my answer to that is, who the hell knows?
Yeah, I'm waiting.
Okay,
for that.
I don't remember. I'm looking to see who it was.
Yeah,
it was Paulie.
It was every number all the way down.
It was Paulie.
Really careful.
Yeah, all right. It was Paulie that said that, and my answer to that is you don't know, because it might seem real cheap as of right now as we sit here and talk about it, okay? But if we get there, you have to reassess, because what if the data got worse? What if China dug in their heels and got even more belligerent and raised tariffs? You're going to buy the S&Ps down there just because 3 months prior it seemed like it would have been like a great spot to get in? You can't do that. You can't presuppose what you're going to do. You can think about it.
Because the answer is it all depends. It always depends. You're right.
You don't know. You have to be careful. But like Judd said, one level at a time. Because maybe we don't even get there. Who the hell knows?
Well, this is all good stuff, guys. And what I would say to people that haven't been in my room or Pags' room or have come in and you're just listening, you should give it at least come in for a trial and see what we're doing. It'll give you another look on your trading, and hopefully, what we try to do is give you low risk opportunities. Especially me, I'm not saying we're going here, we're going there. I mean, I always tell Paulie, everybody's got an opinion. Well, great. Well, let's figure out how it's moving from A to B. And then let's make some money on that move.
Opinions are great, but let the market begin to signal to you that you're right or wrong.
You guys are familiar with that from my room, isn't it? And even people that on Twitter, let the price action tell us. We all have opinions. If I traded my opinion,
it's not. Yeah, it's not for me. Hey, Judd, if you don't mind, I have a theoretical question for Matt.
Okay, go ahead. Then I gotta wrap it up because I'm.
All right. Well, you don't have to say anything. But anyway, okay. So Matt, I was thinking, and I'm pretty sure I know the answer to the question, but I want to hear how you answer it. Let's make believe that the pit goes away. Okay. Just like the Russell, there isn't one, okay? Then without the 8:30 in the morning, quote-unquote, pit open because it no longer exists and you don't have that, what do you then use? How would you adjust your methodology?
Well, it's still the New York Stock Exchange opening, Angelo. So,
So the question is.
Well, I thought I knew the answer to the question, but I wanted to hear what Matt had to say about it.
It's when if they go 24-hour trading of stocks worldwide, then you're not going to have an actual opening anymore.
Not going to have it, right?
Yeah, you just won't have the what is it, the EP anymore?
What do you mean?
You'll have it, but you won't have the SPOO pit opening. What they'll do is, because it's pegged at the 8:30 opening of stocks. If stocks go virtual trading 24 hours a day, which I think will drive most of these companies up the wall, and they wouldn't do it, then it's just futures, 23 and a half hours a day. Everything.
I said to myself, I bet the adjustment that Matt would make is just use the futures trading, the first 30 seconds of the New York Open, the cash open.
Okay, well, yes, and we would absolutely use if there's a New York Open, we're always going to use that. We're going to use the cash open. I don't, the way that we calculate the pit opening is by using the minis and the first 30 seconds of the minis, and that just becomes our opening range. But for example, crude and gold, we use the opening range in gold. I don't trade the opening range in gold. I don't use the opening range as a way to initiate trades in gold. I use Judd's matrix levels to initiate all my gold. I found that gold is, and anybody in my room knows, I found gold is too difficult of an opening range trade. Crude works all the time. You just want to trade one market, make a lot of money, crude. I don't think there is a pit for crude anymore, is there? It's been closed a long time too, but we still use the 8 o'clock open because that's when the bots are turned on. I want to make the highest
volume comes in.
Right. I want to make the highest probability. I wanted to make the highest probability trades that I possibly can, which means that, and that's the third part of our requirement is time frames, where the highest time frames are. And if you take a look at a chart at 7:59 Central, the volume is nothing. You take a look at 8 o'clock Central and gold kicks off. That's still considered the open, even though there's no pit.
Yep.
So
okay.
If we go
I kind of had a feeling that would be your answer.
Yeah. Now listen too. Here on the other hand. On a Sunday night, not so much, and on a reopen, 5 o'clock Central, 6 o'clock night reopen, a Globex open, I'm not going to use 30 seconds for that. I'm just going to use the opening print, and so I'm going to use the opening print as sort of a 50-yard line. That changes the way that I manage positions, because there's no algo. The 4 points that we use to cover the first part of our trade in order to remove our risk, so that the rest of our either 2/3 or 3/4 of our position is now free or risk-free, because we've taken 4 points of risk, which in the S&P, which is what the algos are looking for. It's 10 points in the Nasdaq, and if you look at the crude, it's 20 cents. The first 20 cents of the breakout of the opening range is how we pay for our trades in those prospective markets. 4 points in the SPOOs, 10 and it's 4 in the Russell. And I think it's 10 or 20 in the Dow. I don't trade Dow. You'd have to ask one of the other guys that do. But anyway, we pay for our trades, and then that way we remove our risk, and we can let the algos take us where the algos are going to take us. There's different things with the intraday targets that I have, coupled with Judd's matrix levels, that the way that I trade is designed for two things: to take advantage of the entire day's range. And you can ask the people in this room. And if we don't do that, then somebody here publicly say that doesn't happen. But we take advantage of the days, our targets take advantage of the entire day's range. Then the last part is designed to take advantage of the trend, of the wider trend. And that's how I use Judd's matrix levels. I can hold trades longer. I will hold trades longer. I'll add at certain places along the way. I need those. Rad, Jack Dapp can answer that question for you. I haven't traded the Euro Open, the London Open for a long time.
And you got to be careful with the Euro, because there's a lot of wiggle in the currencies. So sometimes they work and sometimes they don't. And they haven't. And you have to be willing to give the the euro's more wiggle.
Yeah, euros. I'm not a big.
Currencies are a really hard trade because it's all algorithms, it's all bots, it's a lot of retail guys, and it's the banks throwing up a bunch of bullshit quotes, and you're trying to figure out what's real. So in the trade currencies, you have to look at the currency crosses. You can't look at you just can't look at the euro. You got to look at Euro Aussie, Euro Yen, Euro CAD. You got to look at them, Euro Pound. You got to look at them all, Euro Swiss, and see which one's running the show. I mean, you just don't go, I'm going to buy euro or I'm going to sell euro. You better know what's going on with every single cross, or you shouldn't even be bothered. You shouldn't even trade it. You have no business trading it unless you're doing your homework on it. Because if you are, you're gambling.
So I do not gamble. And I don't trade euros because I don't know enough to trade euros. I'm not euros, currencies. I don't know enough. I'm not a good currency trader. I know that. I don't do enough homework. I don't have enough time for it. And frankly, I'm more interested in other markets than I am currencies.
And I started trading currencies when they were on blackboards in 1974. I mean, I don't have time to do the work in the currencies. I look at them and I have alerts on them. And I use them as risk on, risk off, and I might use them as a surrogate, something else as a surrogate to trade them. But, it takes too much attention for me right now, and they've been relatively range bound for me to get involved. And Angela is the one that's made a fortune in the euro this year, in the last year and a half.
Mm-hmm.
So, sometimes you can trade them, and a lot of times you're just better off leaving them alone because they're easier things to trade. And we're always looking for the easier trades. At least I am. Friday morning, all I said was buy silver, buy gold. Buy the silver miners, buy the gold miners, buy whatever the hell you want, but that's going to be the trade. And right now,
I haven't touched the euro in a couple of months.
I said that. What?
I haven't touched the euro in probably 2-3 months.
Yeah, and right now the gold's up $50 since when I started hawking it Friday morning. So,
oh God, the way that I screwed up that gold trade, even Friday I screwed it up. Look, the one thing the one thing you'll always get out of Judd, the one thing that I've always gotten out of Judd was complete and utter honesty. Sometimes just too naked. I would rather have it a little bit clothed, but he's very direct and blunt, and there is no bullshit with him. And I mean, I paid him when I first started trading. I hadn't brought home money at all for my trading account, and he said, "You're going to pay me $1,000 a month, but you're going to learn how to trade." What? 200? Yeah, a week. But I got $250 in my account. Yeah, well, you pay me at the end of the week, and I did. Yeah, money didn't, appear in my. I had to learn how to trust. First, I had to trust him. I had to trust Judd before I can trust myself. He actually made the first 2 trades for me in a yellow coat. Hey, he just bought one from you.
Yeah, but he bet $1,000 on you that week, and you only had $250. So that was
I never looked at it that way. I just figured, I'll walk away from that kid. Well, fuck, I'll go find another one. But I never thought of it that way. We certainly, of course. But I want to get back to that euro trade real quick, and I do want to ask you about that euro trade, Angelo. What was it? How do you do your homework with the currencies?
Well, he's looking at the matrix level. First of all, he's got a global macro. I always had a view on Europe, watching the data, and then putting the trade on at a matrix level. We get a little rally in the euro to a matrix level. That's where I'd put on the short.
Not trading in between.
Not trading in between.
Only looking at the big numbers, the hard numbers that are on the sheets, and not trading any place else.
I'll tell you what. The one what I have noticed
let
Matt,
me make the point real quick first, though, because this is something that everybody struggles with. Every trader does. So, all right, I'm sorry, Angela. I just really have to make this. So what Judd and Angela are talking about is not trading in the middle. And guys, I mean, that's months and months. You know, he's talking about a huge move in euro, in the currency. He's not trading. Every single one of us are having difficulty, not every single one of us, but every new trader is having difficulty not trading in the middle during the day, Angelo. So if we've got an intraday target of 28, you know, if we trade 28.11, we're going to head back up to 28.44, right? Okay. I mean, you know, I'm just saying that that's a level up. And so, you know, traders, you know, independent traders, retail traders that are learning how to trade during the day are you know, they may have those levels, but they're going to make 15, 20 trades in the middle of all of that. There's a term for it called FOMO. I didn't know that FOMO until I started tweeting, but fear of missing out. Everybody's, and you said this earlier, don't be afraid of missing the move, but you were talking about macro. You have to, what I want to get across is that everybody, you know, everybody has a hard time while they're learning how to trade to even just let the market trade the intraday targets and staying out of the chop and staying out of all of the garbage. That is why 95% of traders fail, is because they can't just trade the levels. They never learn how to let the market price action tell them what to do. They're looking at they're trading every point, every level, and every little wiggle in between, and you can't.
No, start off with one thing, right? If you have guys that are new, you know, or newish, just trade the S&Ps and nothing else.
The funny thing,
pay attention to what other things are doing so that you can learn. Okay, but just stick to one market until you perfect that.
That's
maybe.
So important. And you know what it is too? Another thing, Ange, is that it's not, for the most part, it's not always the newer traders. It seems that the newer traders in our room are some of the guys that are doing the best. And the reason that is because they haven't developed any bad habits, and we're doing some one-on-one work, and so they're learning from me, and they're doing very, very well. It's the traders who have been around a while, who have been from room to room, from one mentor to another mentor, that have all of these different habits and all of this knowledge built up in their mind, and so they think that they need to catch every move. They think if they don't, that they're a terrible trader. If they, you know, all kinds.
They got a trigger, a 2-second trigger, and they have to take it, and they don't know what they're taking it for.
You know, and I think it's interesting that it's an interesting way of looking at it from a macro level to the micro level. From the macro level being days, weeks, months, even years out for you, to the macro level of, the micro level of intraday trading from just one of my target levels from another, whether it's 10 points away or 20 points away, and or 30 points away, and we have them both. It's difficult to not trade in between, but once you learn how to do it, that's when you are going to put yourself in a spot of being a long-time profitable trader.
I mean, it's taken me 5 years of intensive study and whatnot to get to this point. You know, of trading a lot of different things at different times. Sometimes, you know, simultaneously, but mostly separately. But what I was going to say about currencies is, what I've noticed is they tend to move from point A to point B the fastest. They tend to be a lot quicker about it.
All right, so here's the thought. So with that, here's the thought of so many intraday traders is that they get whipsawed in between that they can't trade currencies. I'm done with it, you know. And I don't trade them only because I'm more comfortable trading other. But you know what I mean. So it trades too quick. There's not enough in there, you know, which goes right to what you're saying. Trade the levels, trade the targets. That's it. Trade the macro levels. That's all.
But you need to. For me, I like being short a lot on stuff. So when we're in negative markets, that suits my personality better. All right, I just like it. I just like it when shit goes down. I just have more fun at it. I don't know why.
Here, take a look at this euro, okay? And this is why I don't trade it all the time. 2016 and 17, everybody in their mother on mainstream media, we're going to par, we're going to 90, we're going to 80.
Oh, I remember that.
There, okay. My work said it was sold out. There was no more downside, and I had hard numbers, and it's like there's no more downside. But it took almost 2 years to turn before it rallied, and again, 2017 in September, the 1st of October, Iris Credelli asked Ira a question about the euro. He said, I want to sell it at 125.5. I didn't see how it was going to get there from 110, but it went there, and that was a stone cold high.
I remember that.
So, he does his homework. And a lot of times, especially the currencies, they take a long time to develop. So you have to be really patient with them. It's not like, oh, I got to be in. I got to be in. You remember how many times you could have bought the euro and been broke before it finally took off?
I mean, Matt, I started buying the dollar the first quarter of 18, and I sold it out January of this year.
Yeah. I mean, it takes a while for these things to develop.
And then along the way, I was, I shorted the euro a couple of times, but at matrix levels.
At matrix levels, that's the
okay.
key. So
and why did I short it? Because I knew that Europe was going to continue to have economic troubles. Or not new. I mean, that was just my view.
Both.
Angelo. Oh, sorry. I was just going to say, Judd's matrix levels helped me both in my longer term position and trading it on the ORB at a matrix level, and then knowing when to pull them off. So I was able to clear the table because I had been short for a year and a half, entering what would have been around matrix levels. And I knew when to clear the table because of it. So yeah, it does work. Yeah. You just got to be patient.
I only shorted from one matrix level to another. Then I'd cover, and then I'd wait and see what would happen. Let the board reset. Then the euro would rally, go back up to the same frickin' matrix level. I'd short it again. And that's basically where I'm at with the Russell, man. The Russell keeps doing the same damn thing.
It does. Now here's the thing for all of us. The way that Angelo trades, obviously, weeks, months, days, weeks, months, years, that's the same. It's the same for us. That's why they call it macro, micro. It's the same for us. It's just micro. We are doing the exact same thing every single day, only what we're doing also has an eye on the macro. If it's a third of my position or if it's a quarter of my position, I leave that on for the macro breakout to the next matrix level. While during the micro or intraday trading, we have our methodology of how we not only enter our trades, but how we manage our trades so that we don't have any risk on our trades. It's a free trade, especially if this is a position that we're going to wind up taking for overnight at least, with an eye on tomorrow, next week, next month, next year, and I've had trades that have lasted that long that start with the first, by letting the algos do the work for me. When I was on the floor, when we were on the trading floor and I was in the pit, it was my job to move the market. It was my job to paint the tape, especially as I became a big trader. So if the opening range was, like last week, 04 to 08 or 08 to, I forget what it was, 08 to 10. Underneath 08, I'm short. I know that I'm going to cover my position here, but I had to sell the evens and the 99s and the 97s, and other traders did too. And we would work together and help one another out. But we had to paint the tape. Now the algos do that. And everybody wants to fight the algos. Everybody wants to pick a high. Hey, I sold 53.43s in the crude today. I sold the high. Look how brilliant I am. I don't care about that. What I care about is how did I trade my plan that day. My plan is what's going to get me to where I need to go financially. So back to the micro. Now I'm not trading in the middle. I'm trading at my targets. I'm initiating trades out of the opening range. So I sell them. I cover my trades the way that I cover. because that's how the algos do it. And then I let the algos do the work. And I've taken profit at least twice before a position goes home with me overnight. And then I'll add to it the next day the same way, the same way, same way. So think about October, November, December, the size of the positions I had, and I didn't have any risk on them. At worst, you know, it was a scratch because I've taken position, or I took profit 2 or 3 times at the minimum before I took it home. All the while having good intraday, you know, intraday profit. So trading is a lot of things. Like Judd said earlier, there's a million ways to make money trading futures, but one way that or trading the markets, one way that is in my opinion common in every single trade is how you manage your position. If you do not know your second trade first, then you have no business putting on that trade. If you do not know where you are wrong before you put on the trade, where the market's telling you you're wrong, not your P&L, but where the market is telling you that you're wrong, do not put it on, especially for micro intraday traders. If you don't know where the market's telling you that you're wrong, being short, you don't know where the market's telling you being wrong, being long, don't put it on. Wait, be patient. You don't need to catch every move. It's better. Your job isn't to catch every move. Your job is to be here tomorrow so that the move that you see clearly, the big move, the one that you've been waiting for, you can get on. And you're not making up for lost time or lost money. You're just putting on the trade, because it's not about trading is never about time. It's never about, it's about distance traveled, not time traveled. I'm looking to take money out of the market every day, little chunks of money out of the market every single day. I'm just letting them, the algos.
It's always distance traveled, not time in the trade.
That's right. And I'm not trading to be right.
You trading to make money. All right, guys, this has been a great session. Pax, thanks.
Yes, thank you, Judd.
Everybody that's in.
Good night, guys. Pax and I do this every day, all day long. Yep. So, you should come in, sign up, and learn.
Absolutely, everybody. Thank you, Judd. Thanks again. You know, everybody get some rest. I think that these next few days, these next few weeks are going to be incredibly interesting, very busy.
Oh, it's going to be busy because, yeah. We already talked about it and people aren't even looking at it. And it's the European bond rolls that are going to really set off the equity indices, and people aren't even looking at that yet.
All right, I gave all that to you guys, so please make sure you print that off. I told you on Friday, I can't express how important that is, that you have that calendar next to you. So important.
All right, guys. Thanks again.
Absolutely. Thanks, everybody. Write down Judd, what's your
www.whitewavetradingstrategies.com.
I'm sure.
When we get this rendered, I think Jack will send it out to everybody.
Oh yeah, that's right. Here I am trying to be.
And we'll tweet it out.
All right, everybody, have a great night. Seriously, thank you for being here. Chris Simps, stay short and long. Don't cover yet. Talk to you guys later.
Okay. Adios.